Hello everyone, welcome back. Now I had some issues, so what we are going to do is now this is where I left off with the E part, and E part was that how the situation changes if the company follows IFR or SP. Like I said before in our previous recording, if the bond is recorded at the fair value, so what we have is we started off with a carrying amount. The carrying amount in our books was 850,760 and 97 cents, and the fair value of our bond was at the time on December 31st. They told us in the question it was 838,000. So difference between those two, our liability in this case, we're doing bonds payable, so we have a liability, and then our liability went down, so it is called gain on a bond. Gain on a bond. Due to change in credit risk. So difference between those two was 97 cents, 617, and it's 12,797 cents. How do we record it? Like I said that in my previous recording, but I'm going to do it again. If the company is following an IFRS, this gain or record will be going through the other comprehensive income. If the company is following an ASPE standard, this gain will be going through a net income. So when we think about net income, then what do you think of it? It is an unrealized gain and loss. However, ASPE company does not have a OCI. So what will be my journal entry? My journal entry will be a bond payable here. Will be for the $12,716.97, and that will be my debit, and my credit will be unrealized gain and loss. Unrealized gain / loss, OCI. So if it's other, OCI stands for other comprehensive income, and you have learned those ones in chapter 4 of your volume 1. So that will be my credit entry, 97. And then when you're recording the same entry under the ASPE, there your gain and loss will be booked through net income, and then you're going to do a debit is going to be bond payable because your liability went down because there's a change in fair value. 12,716.97, and then credit will be unrealized gain / loss. So there's going to be unrealized gain and loss, but it's not going to be this is the gain and loss. It's called 12,716.97. So this will be your entry. So in other words, they both are unrealized gain and loss. One is called an OCI, the other one is just a normal gain and loss, which is when it's a normal gain and loss, what does that mean? It goes through the net income. So if it goes through the net income, then we know that it will be booked through the other revenues and expenses. So let's look at our next one, what the next question that we had to do. Now I think I had to do 1416 next. So let's take our next question and see if we could if you could follow it. I know seems like it's a lot of it's a big question, but however, no question is a big question if you can just take it simple way of answering that question. So let's do part A, and I always read the requirements before I could go further into the calculation. So then what they're saying is we are recording the issuance of the bond on June 30th. So let's see what's happening. On June 30th, 2020, Mosca Limited issued 4 million of 20-year 13% bond for 4,390,920,000. So that's, we issued it. They already told us in the question the present value of the bond. So of course, at the time you issue the bonds on June 30th, 2020, you're going to debit the cash and you're going to credit your bonds payable. The bond payable will be recorded at the present value. In this case, it will be 4,309,920. So that's the present value of the bond. So that's the answer to 1. So now the second question is asking the payment of the interest and amortization on December 31st. We needed to know if the company is following a straight line method or an effective method. In this case, the company is following an effective method. If the company is following an effective method, we need to have 2 rates. Did they give us 2 rates? Yes. There's a 13 is your stated rate, which is your coupon rate, and then your yield rate is 12%. So let's do actually maybe I could do it this side so I don't make mess out of my screen. So let's do the second entry, which will be on December 31st, 2020. My entry will be, so we know the bond, in this case, bond is issued at a premium. How do I know? Because the face value of the bond is 4 million and the present value of the bond is $4,390,920. So let's do the entries. We know that you could do it amortization tables, but I am going to do it without the table. So debit the interest expense, debit will be bonds payable, and credit will be my cash, but I don't know what the numbers are. So the cash will be using the face value of the bond multiply by the I'm getting used to the 10%. In this case, it's 13%. We issued the bond on June 30th, and then now we are at December 31st. So then 6 divided by 12. Then you're going to calculate your interest expense. In this case, I already worked it out. That's your 260,000. So that's the cash we are going to pay. Then the next one is to calculate your interest expense. Interest expense is always calculated using the carrying value of the bond. In this case, the carrying value of the bond is 4,309,920, and we use the marker rate. In this case, the yield rate, which is going to be 12%, multiply by 6/12 will give me an interest expense of 258,055, and that's my interest expense. So difference between the both is my bonds payable. In this case, the bond payable is 1945. Now you could do an amortization table. Some of you guys might wanted to do amortization table because now it might be easier to do it because then they want to do an entry for 2021 and then 20 on December 31st. So I'm going to show you in the table. The question is not asking you to do a table. So, but I'm going to do it. So let's start with the June 30th, so then it is a little bit easy to navigate it. 2020, then I look at it, I look at my cash that we paid. We have an interest expense. In this case, we have our premium bond, so premium amortization, and then we have a carrying value of our bond. So the carrying value of the bond on June 30th was 4,300,920. So that's what we started off with. So we know that we started off with cash payment does not change. So the cash payment does not change. The cash payment does not change. So it is going to be the same every year. So when we are doing it, this is going to be 260,000, and I think our next payment is June 30th, 2021. I'm just going to put that in there, and then we have a December 31st, 2021. That will be also 260,000. But when you're calculating the interest expense, what you're going to do is you're going to calculate using your carrying amount. So the interest expense will be calculated calculating the yield rate. So in this case it will be your 12%, and this is your 13%. So you can always, we know this is the annual rate, and then the payments are made semi-annually. You can convert this rate to make your life easier, and then because you don't want to multiply it all the time. So in this case, you could do it this way, or you could just take the carrying amount and then multiply by the numbers if you want it. So let's do that. So I'm going to use a different ink to do my first calculation. So in this case, I'm just going to put it underneath it here so it is a little bit easy to see. Multiply by the 12% times your 6 divided by 12, and we already got the answer before, but I'm showing you the table, but you don't need to show me the table. So but it's some, if you're asked to do the table, then you do the table. If you're not asked to do the table, then you do not need to do the table. So that's the thing. So you're going to keep going with all your calculations. So in this case, it is a premium. So if it's a premium, I will minus it. So let's see if I get the number 4300920 minus the 1945. I got a number of 4298975. So that becomes my carrying value after my first payment. So now I'm making the second payment. This was my first payment. Now I'm making the second payment. Second payment when you're making it. So you're going to do 4298975 multiplied by 12% times 6 divided by 12 to get the number, so I can see how much is my amortization is going to be, times the 12% times 6 divided by 12. I got a number. I'm going to round it up. I got a number 257939. So in this case, what we're going to do is I take the difference between the cash we paid and the interest expense, and I'm going to get my amortization. I round it up. So in this case, it will be 2061, and I'm going to be minusing it. When I minus it, 4298975. I hope my numbers are correct because nobody's checking my numbers. 4296914. So that's my number. So let's go to our next one. When you're calculating our third payment, so I'm just going to do it here so that you know that these numbers, how it is showing, so it's easy to see it. So let's do that. 4296914 multiplied by the 12% times 6 divided by 12. So I am going to do it myself. Times 6 divided by 12. I'm rounding it up, 257815. Take the difference between those two is your 2185, and then I minus it to calculate the liability. So I will take 2185 minus 4296914. I get an amount of 4294729. I will be posting the solution so you can check your solutions with my answer. So what the question is asking us to do is, the question was asking to journalize it on June 30th and journalize it on December 31st, 2021. So journalizing is easy when you have the table. So my next entry is to calculate to journalize it on June 30th, 2021. Then all I'm doing is picking up the numbers and doing my entries. But let's do it. So we have an interest expense of 257,939. We have a bonds payable. Our bonds payable is going to be our first one. We did the first entry. I'm doing the second one, sorry. 2061, and then we have a cash. Our cash is not going to change, 260,000. Then I have to do an entry for December 31st, 2021. I have a debit of interest expense. I have a debit of a bonds payable. I'm getting the numbers from here. So I know it's 257,815 and my bonds payable is 2185 and our cash amount did not change. So it's still stays the same, which is 260,000. So we already answered it from the table. So what we are going to do next is what the question is asking us to do. B. So we have to answer B. So let's answer the question B. Show the proper presentation for the liability for the bonds payable on December 31st, 2020. So what the question is asking, what bond should be recorded at? It makes on December 31st. So your bond should be reported at a carrying value. That will be your 4,298,975. So the question is asking how the bond should be reported on your balance sheet. So of course, if you are reporting it on the balance sheet, so we're answering it. The answer for B is you have under the long-term liabilities, you're going to have a bond payable, and bond payable is going to be recorded at shows as a carrying value. So will be 4,298,975. So that's the value of our bond will be. So and then we normally have a note, and that note will have an amortization table. So that's how we record it. So now that was my B. So I'm going to go to the other side, see what the next part of the question is asking us to do. So in this case, table would have been nicer to do, even though the question didn't ask for it. A table would have been good to do because we could answer a lot of questions if you are asked to do a lot of questions. So the question is asking, what amount of interest expense be reported in 2020? Of course, we did an entry, so we know I can even tell it from here. So from June 30th to December 31st, we only had one payment. What interest should be reported? In this case, the amount should be, I'll just write the amount, 258,055. So that's the amount that should be reported in our on our income statement. Then they're saying, will the bond interest expense that is reported in 2020 be same, greater than, or less than if the company follows a straight line method? So we already reported it. They wanted to know, should that be more, should that be less? What we have to do is, in order for us to do that, we needed to calculate it in order to find out how much is going to be. So now if you were to do it, now we have a present value of the bond and we have a face value of the bond. In this case, the present value of the bond was 920. So we're answering number 2. In this case, we're answering the number 2. And the face value of your bond is 4 million. So difference between those two is my premium. In this case, that's the premium. If the company is following a straight line, we wanted to know if the bond is amortized over the life. In this case, it's 20 years, so you could do it two-way. In this case, there's 2 payment in a year. I can times by 2 to get the number, or what you could do is you could divide it by 20 and multiply by 6/12. In this case, I got an answer. Let's see, 7523. So that will be my premium amortization. So in this case, that's my premium amortization. So that's my premium amortization. So when you're, of course, the cash, that's, if I were to, it's nicer to show it in a journal entry. So I have an interest expense. I have a bond payable. In this case, we know our bond payable is 7523. The cash we paid was 260,000. That is calculated using the face value of the bond. In this case, the difference between the both will be 252,477. So what the question is asking, will the bond interest expense reported in 2020 be same? It's not same, so we know it's not same. Is it greater than? No, it is not greater than. It is less than. So the answer is it is less than. So the answer will be it is less than. What are you comparing it to? The interest expense under the straight line was 252,477. So what you are answering is it could be a multiple choice question asked if you look at it. So it's saying that difference between two is more, less, or same. So it's not same. Is it more? No, it's not more. It is less than, or a smaller than, if you want to look at it. Now the question number 3. Let's answer the question number 3. It's saying what is the cost of borrowing? What is the cost of borrowing over the life? So when you have a life of the bond, so they wanted to know how much is the cost of borrowing. Sometimes we don't see it. We think it's we're making interest payment. It's very good. We don't need to pay the principal. When that happens, I will show you. It might surprise you how much interest the company is paying on this bond over the life. So let's do the question. So first of all, what we are doing is how much interest are we paying on this bond? Will be the end. Okay. We're doing number 3. Number 3, we use an effective method. So the interest that we are going to pay over the 20 years. So if I were to do that, I know my bond was for 4 million. My coupon rate is 13%, and I made 20 payments. So this is how much interest I paid. So in this case, how much interest we paid will be, if I multiply it, 4 million, we issued 4 million, 13% for 20 years. So then this is the interest we paid on the 4 million bond over the 20 years. So this is the interest that the company paid. Now what happens to it that we pay? This is just the interest we paid. We still have to pay the principal. So what we are going, this is the interest paid at the end of the 20 years. What we're going to do is we're going to make a principal payments, because our principal payment still is there. So we're going to make a principal payment of 4 million. So if we made a principal payments of 4 million, I think this question goes with if the company is following a straight line method. So that's what we're doing. If the company is following a straight line, so the principal is there. So in this case, now when I add, this is the total cash outflow that we paid. So let's see how much cash we paid. So now if I add it together, 14,004,000. But at the first entry we did is they gave us cash, so we received some cash. Remember, when we issue a bond, we recorded a debit the cash, credit the bond payable. This is the cash we received when we issued the entry. That was our present value of our bond, 4300920. Now this is the cash we received. So difference between those will be the borrowing cost over the life. So that will be your borrowing cost. I should put it the other side. So my borrowing cost was over the life of 20 years. Is I take the difference, in this case 10,900,000. So if you look at it now, the company borrowed a 4 million bond and they paid over 10 million for that. 10 million of the cost of borrowing. That's the cost of borrowing. Now at the end, if it doesn't matter if the company is falling, and this was effective because we use the 13%. This is just the interest at the end of the day. It doesn't matter if the company is falling an ASPE or IFRS. At the end, we're going to come up with the same number. So it will be same under IFRS, and the borrowing cost will be exactly the same. So that was our 1416. Now the next question that I wanted to do is 1417. Was it 1417 that we have to do, or 1418? We do. I have 1417. So let's do 1417 next, and then we will do 1419. and then we will I will do this will be my second part of the recording, and then I will do another recording for the next one. So let's do 1417. So what is the question asking us to do? This was the calculate the gain or loss to record refunding transaction. Means you retire the bond early. If you retire the bond early, what happens and how you journalize it. We learned it. Let's do it together. Friedman Corporation has a bond outstanding with a maturity value of 5 million. So we know the face value of the bond is 500,000. On April 30th, 2020, when the bond had an unamortized discount was 10 million. So now in this question, they told us unamortized discount. So like I said, that when you have an unamortized discount, they didn't tell you what the amortized was. Then you take the face value of the bond, which is 500,000. We have an unamortized. Then we needed to know, is this a discount or a premium? So we have an unamortized discount. How much is our unamortized discount? In this case, it's 10,000. So I'm saying it as we go, so that if you can't read my handwriting, you're able to make sense out of it. The face value of the bond was 500,000. The unamortized discount was 10,000. It is given to us, and that gives me the carrying value. So we come up with the carrying value of our bond, that are sitting in our books, which is 490,000. So then we needed to know how much cash did we pay, how much we called it for what this bond is callable. They were callable at 104%. So that's the cash we paid was 104. So in this case, the face value of the bond was 500,000. They were callable at 104%. In this case, it will be 4 times 5 is 20, so it'll be 520,000. Then the carrying value of your bond, since you're retiring it, you have to get rid of that bond from your books. You're going to debit your bond payable. That'll be 490,000. So the carrying value of your bond was less than what we paid. So in this case, we have a loss. How much is my loss? My loss will be loss on a redemption of a bond. So it's called loss on redemption of a bond, which is going to be the difference is 30,000. So this is my debit. So in this case, loss is always debit and gain is always credit. So what the question is asking us to do an entry on April 30th. So that will be the entry. They didn't say, oh no, they said to do all the transactions. So we have to do all the transactions. So this will be my transaction on April 30th, 2020. So what they did is they retired the bond. So what happens is they retired one bond and they issued a new bond. So if they issued a new bond, what happens? So what happens to the new bond? Oh no, before that, the newly issued bond had a life of 10 years. The new bond was issued at 103 face value of the bond. 500,000. Issuing cost related to the new bond was 3,000. At the issue cost was capitalized. Friedman prepares financial statement according to the IFRS. If it's according to the IFRS issue, the issue cost is part of my cash. So if that is part of my cash, I needed to take it out because I'm not allowed to capitalize the issuance cost under the IFRS. So let's do our entry now. Our cash is, they told us we issued it at 103. So that's the face value. So then in that face value, 3,000 is already in it. So if 3,000 is already in it, what do we do with that? So in this case, they told us it's how much is that? So we know they said that 500,000 multiplied by 103%, it gives me 515,000. For in this 550,000, 3 is 3,000 is already in it, so I needed to take it out because I cannot amortize that. So if I cannot amortize that, that's the cash I'm going to do. I'm going to receive 512,000, and credit will be your bonds payable of 512,000. If somebody will ask, what do I do with 3,000 entry? 3,000 entry will be expense, so that will be expense. In this case, we are not allowed to, under the IFRS, we're not allowed to capitalize it. The only thing we could do it is that we expense it. So this is why we are expensing it. Now in the 18, we had to do 18. Maybe we can do 18 before we can get to the 19. Or what we could do is, 19 is taking us back to the 18. So we need 18 before we could get to the 19. In this case, I do not have a question. If I do not have a question, I cannot do the 18. So what I'll do is I'll stop my recording here, and then I will get the question for 14, 18, and then I'll continue my recording to do my 14, 19 with that using an effective method. So I'm going to stop it here, and